Hey everyone, welcome back to the channel. Today, I'm excited to share one of my go-to strategies for days when the market gaps up. This is a powerful price action setup that you can add to your toolkit to make high probability trades in these unique market conditions. If you're looking for a reliable way to capitalize on gap ups, stick around because this strategy could be a game changer for your trading. Now let's get into it. What is a gap fill strategy? The gap fill strategy works when the stock is in an uptrend, so the momentum is on our side. There's a gap up where the stock opens higher than its previous day's close. When the market opens, price sells off to fill that gap, reaching the prior close. Once the gap is filled, we see a recovery back up, which is our trade opportunity. Now let's put that into example really fast on the S&P 500 that I took two trades, which I would like to show you today. Now here's how the strategy works. You got a gap up. This is the prior day's close. This is Friday's closing session on the 5-minute chart where each candle represents 5 minutes from opening to closing. And we see a massive gap up. So on Friday's session, the market closes at 595.51 and we open up at 598.81. Usually you see a quick run up, but in most cases, the market will not be able to sustain those gains. And what it will end up doing is after tricking and trapping a lot of traders, it goes down and fills the gap there. And this is where the trade opportunity comes in. So stick with me for a bit. We're going to cover why this strategy works and how to take advantage of this beautiful strategy on the days that the market gaps up. So let's talk about why this strategy works. Gap fills are all about market psychology and predictive price behavior, making them a valuable tool for traders. Let's break it down. When a stock gaps up, opening higher than the previous day's close, it generates excitement and optimism in the market. This surge is often driven by increased demand in the pre-market trading, as we can see here. This gap up here is a good thing itself. It means that price action is so bullish that traders don't even wait for the next day. They just buy up overnight, and that leads to a big gap up. However, what tends to happen is we will sell off back down, fill the gap, and that's where the strategy formulates. The gaps also represent untraded price zones, creating a natural pull for the market to fill in the blanks, which we will talk about shortly. At the open, several key dynamics unfold. Profit taking by early buyers. Traders who held positions overnight may see the gap as an opportunity to lock in profits, creating selling pressure. That's the first major supply that you get. Then you got short sellers add pressure. Short sellers often view gaps as a potential overextension, betting that the price will revert to the previous day's close. Liquidity magnet effect. The gap acts as a magnet, drawing the price back to the previous day's close due to the lack of trading activity in that range. Markets seek balance, and filling the gap restores equilibrium. So in this case, what you're essentially doing is you are going back down, collecting a lot of liquidity. And what we are essentially avoiding in this case is the unfilled price range here. When you got this unfilled price range, you have no established support. You don't have a strong level for buyers to step in and buy. So this territory here, this blank space here creates that prophecy for the gap to be filled. And this is where the buyers will show up and buy the dip, getting some really nice trades in. Once the gap is filled, a key shift in market sentiment occurs. Selling pressure exhausts profit takers, short sellers already completing their trades, securing profits on their trades, reduce downward force. Buying regains control. Traders waiting on the sidelines see the gap fill as a natural support level and step in, creating renewed buying interest. I shared with my team that I'm going to be sitting on the sidelines on the S&P 500 until we fill that gap. Unless we fill that gap, I'm not going to be trading there. So as you can see there, if spike in gap fill, that will be nice to trade. An hour later, this added a really good opportunity for me to buy the dip. So again, once the buyers regain control, we get that renewed buying interest. We get a lot of liquidity from all of that sell-off, and momentum picks up, and then we get the recovery back up. Momentum traders and algo traders join in, accelerating the move back up. Here's how you can execute this strategy step by step. You're seeing that the market has gapped up. You're identifying stocks that are gapping up during pre-market. You're confirming that the stock is in an uptrend by looking at the daily chart, and you're seeing that the trend is going higher. However, we may see a pullback at the opening session to collect some liquidity, because the higher you are during that opening session, the lesser the demand is going to be. Mark the key levels. Draw the previous day's close as your gap fill level, and be patient throughout the day for that gap to be filled. This will be your target for the initial sell-off to come to an end. So step 3, wait for the gap to be filled. At the market open, watch for the price to retrace back to the gap fill level. Be patient and do not enter the trade early on. Do not fall for it. The market will try to get you. For example, you can see right here, it got a lot of traders in. It sucked a lot of traders there. It sucked a lot of traders there. And that pretty much just led to a job-based drop and got the liquidity to get to that gap fill. So don't fall for the candles that you're going to see early on. Keep it in the back of your head that the chances they're going to fill the gap is going to be very high, because that's the best opportunity for the traders who missed out. You get that liquidity, and once you come down here, it behaves as a spring, and it just rebounds right back up with renewed buyers showing up. So step 4, enter on the recovery move. Once the gap is filled, look for the signs of reversal, such as a strong bounce or bullish candlesticks. This is your entry point. Now, if we move on to the 2-minute chart, you can see a morning star reversal. A morning star reversal is simply a 3 candlestick pattern. You got a breakdown candle followed by a doji move back up, and then a large engulfing candle. So in this case, if you were looking on the 2-minute time frame, once that gap was filled, you caught this beautiful reversal there, and you got this really nice trade in down there. So really nice trade right at the gap fill, and you can see this is where the gap fill was right here. That's where the gap fill was. They filled the gap, created that demand candle right back up, engulfed the prior breakdown candle, and that triggers that reversal move back up. So this is where I entered on that trade, made some really nice profits back up, and that's the high probability trade strategy right there. On the days that you know that the market is bullish, on the days you know that the market is in an uptrend, and we see that gap up, and you want to take advantage of the gap up day without having to chase stocks, because what essentially happens, you have so many traders that are buying the dips around here on not just the S&P 500, but even all of the S&P 500 stocks. And what ends up happening is by the time you go down there, they're already down so much. So yes, the market does recover. However, if you wait it out patiently and buy the dip down there, you're going to be in a much better condition to reap the benefits of this given day where the market gaps up and doesn't provide that sort of opportunity for the bulls to make any money until you get that gap filled. And team, usually the gap up will be at a key resistance level. In this case, we can see the gap up touched that prior resistance level, which is the historic all-time highs on the S&P 500 at 600. And once we tested that resistance level, knowing there's going to be a lot of supply orders, the chances of this gap being filled are usually high. So market psychology is very, very important to understand, and we're all about that. So thank you so much for watching this video. That's a wrap on the gap fill strategy. This is a setup I highly rely on whenever the market gaps up and the conditions align. It's powerful, simple, and rooted in market psychology. If this strategy resonates with you, or you've had any success trading gaps, let me know in the comments. I'd love to hear your thoughts as well and your approach to this particular strategy. If you found this video helpful, don't forget to hit the like button, subscribe for more trading strategies and tips. Thank you so much. Thank you for watching. I'll catch you in